Imagine a world without money. A world where the concept of currency doesn't exist and people rely solely on the goods they produce and the skills they possess. You are a farmer with a surplus of grain. Your fields have yielded a bountiful harvest and you have more grain than your family can consume. You need tools from the blacksmith. Your plough is broken and without it, next season's planting will be impossible. But what if the blacksmith doesn't need grain? He might already have enough food for his family and need something else entirely, like leather for new bellows. This is the challenge of the barter system. It requires that both parties have something the other wants at the same time. It relies on a double coincidence of wants. This means that for a trade to happen, both you and the blacksmith must have exactly what the other needs. Both parties must need what the other has. If this coincidence doesn't occur, no trade can take place. This makes trade difficult and inefficient. Barter limited early economies, making it hard for communities to grow and specialize. It was hard to establish consistent value. What one person considered fair might be seen as unfair by another. A cow might be worth a different amount of grain depending on who was trading. The value of goods was subjective and fluctuated widely. Storage was also a problem. Grain could spoil, and livestock required constant care and feeding. How do you save your wealth when it's a herd of goats? Livestock can die and grain can rot, making it difficult to preserve wealth over time. Despite its limitations, barter was an important step. It allowed early humans to exchange goods and services, laying the groundwork for more complex economic systems. It laid the foundation for trade. Barter showed the potential of exchanging value and the need for a more efficient system. It showed the need for a more efficient system. The inefficiencies of barter highlighted the necessity for a standardized medium of exchange. Human ingenuity would soon provide a solution. The invention of currency revolutionized trade, making it easier, faster, and more reliable. People began using common goods as a medium of exchange. These were things with intrinsic value, like salt, cattle, or shells. This was the birth of commodity money. Commodity money had advantages over pure barter. It was more divisible. You could trade a small amount of salt for a smaller item. It was also more durable. Salt doesn't spoil as easily as grain. However, commodity money still had its drawbacks. It was bulky and difficult to transport. Imagine paying taxes with a herd of cattle. The search for a more practical solution continued. Around 600 BC, a revolution occurred in Lydia, which is modern-day Turkey. This small kingdom, nestled in the western part of Anatolia, was about to change the world in a way that no one could have predicted. They minted the first standardized coins, a groundbreaking innovation that would transform economies and societies. These coins were made from electrum, a naturally occurring alloy of gold and silver. Electrum was chosen for its durability and intrinsic value, making it an ideal material for currency. Each coin had a standardized weight and was stamped with the seal of the king, ensuring its authenticity and value. This standardization was a game changer, providing a reliable and consistent medium of exchange. It provided a portable, durable, and easily divisible form of money. People could now carry wealth in their pockets, facilitating trade and commerce in ways previously unimaginable. The use of precious metals also ensured intrinsic value. People trusted these coins because they knew the metal itself was valuable. This trust was crucial for the widespread acceptance of coinage. The invention of coinage spread rapidly across the ancient world. Neighboring kingdoms and empires quickly adopted this new form of money, recognizing its advantages. It facilitated trade and economic growth, allowing merchants to conduct transactions more efficiently and with greater confidence. Coinage allowed for more complex transactions and the development of more sophisticated economies. It enabled the recording of transactions and the creation of early bookkeeping systems. This innovation laid the foundation for modern monetary systems. From Lydia to the world, the concept of coinage has evolved, but its core principles remain the same. Today, we see the legacy of Lydia in every coin and banknote, in every financial transaction, and in the very structure of our global economy. Carrying large amounts of coins was still inconvenient. In the 7th century AD, China introduced paper money. This was initially a form of promissory note backed by the government. Merchants could exchange these notes for copper coins, which were bulky to transport in large quantities. Paper money was revolutionary. It was lightweight and easy to use. It simplified trade and allowed for larger transactions. The adoption of paper money spread slowly at first. It took centuries for it to become widely accepted in Europe. However, its impact was undeniable. It paved the way for the modern banking systems we use today. Section 5. Banking and the Gold Standard. Trust and Stability. The foundation of modern banking and economic systems can be traced back to the establishment of trust and stability within financial institutions. As trade flourished, banking systems emerged. These systems were essential in managing the flow of money and goods, ensuring that transactions were secure and reliable. Banks provided a safe place to store money. They became the cornerstone of economic security, offering individuals and businesses a trusted place to keep their wealth. They also facilitated lending and borrowing. This spurred economic growth. By providing loans, banks enabled businesses to expand and individuals to invest in homes and education, driving overall economic development. In the 19th century, many countries adopted the gold standard. This system linked the value of a country's currency directly to a specific amount of gold. This meant their currencies were backed by a fixed amount of gold. It provided a tangible assurance of value which was crucial for maintaining public confidence in the monetary system. The gold standard provided stability and predictability. It ensured that the value of money remained relatively constant, which was vital for long-term economic planning and investment. It fostered international trade by creating a fixed exchange rate system. This system made it easier for countries to trade with one another, as exchange rates were stable and predictable. The gold standard wasn't without its flaws. Economic instability could arise when the supply of gold did not match the needs of the economy. It limited the ability of governments to control their own monetary policy. During times of economic crisis, governments found it difficult to adjust the money supply to stabilize the economy. Economic shocks could also lead to gold shortages or surpluses, disrupting the system. These disruptions could cause severe economic downturns, as seen during the Great Depression, when the rigidity of the gold standard exacerbated economic woes. Section 6. Leaving gold behind, the rise of fiat money. The 20th century witnessed a major shift. Countries moved away from the gold standard. They adopted fiat money. Fiat money is not backed by a physical commodity. Its value comes from the government decree. This shift gave governments more flexibility. They could adjust their monetary policies to manage inflation and stimulate economic growth. However, fiat money also introduced new challenges. It relies heavily on public trust in the government. Irresponsible monetary policy can lead to hyperinflation and economic instability. Section 7. The digital revolution, banking in the information age. The late 20th century brought about the digital revolution. Electronic banking and digital payments became increasingly common. ATMs, credit cards, and online banking transformed how we interact with money. Digital money is convenient and efficient. It allows for instant transactions and global commerce. But it also presents challenges, such as security risks and the potential for financial exclusion. Section 8. Cryptocurrencies, a decentralized future. In 2009, Bitcoin emerged. Bitcoin is a cryptocurrency. It's a digital currency that uses cryptography for security. It operates independently of central banks and governments. Cryptocurrencies like Bitcoin have sparked intense debate. Proponents see them as a revolutionary technology that promotes financial inclusion and challenges traditional financial systems. Critics, however, express concerns about their volatility, potential for illicit use, and environmental impact. The future of cryptocurrencies remains uncertain. Section 9. Central bank, Digital currencies, the next frontier. Central banks around the world are exploring central bank digital currencies, or CBDCs. These are digital versions of a country's fiat currency. They combine the control of central banks with the efficiency of digital money. CBDCs have the potential to revolutionize payments, reduce costs, and increase financial inclusion. However, they also raise concerns about privacy, security, and the potential for central bank overreach. Section 10. The ever-evolving landscape of money. From bartering to Bitcoin, the story of money is one of constant evolution. Each innovation has brought about new possibilities and challenges. The future of money is likely to be just as dynamic and unpredictable. One thing is certain, money will continue to shape how we live, trade, and interact with the world around us. Understanding its history is crucial to navigating its future.